Hey everyone, Adam Tracy, and I want to talk about reverse mergers. I've talked about it a little bit before, and I've done quite a few of them myself in the past, and they're getting renewed, I guess, attention because you see a lot of Chinese interest in buying public shell companies. And just as like a quick primer, reverse merger is basically the purchase of an existing publicly traded vehicle where you merge an operating entity into it, change control, and it's like this backdoor IPO. And it it is becoming a more desirable vehicle because you see the Chinese re-entering the market. And there's this great documentary on Netflix called The China Hustle. I think it's actually off now, but you saw right around the crash, pre-crash of 2008, tons of reverse merger activity, and it was like all just scam. It was all bullshit, and like that's been the reputation of reverse mergers throughout time. Like you just there's been very little oversight, but now with Chinese coming back in and a greater degree of oversight on OTC markets, it's becoming a more popular route. And for blockchain companies in particular, who want to give liquidity but realize that there are no real viable markets for security tokens, find the reverse merger as some indicia of liquidity through common stock versus a tokenized security. So you see a lot of blockchain companies jumping into them, and that liquidity, in theory, gives you greater access to capital and the like, and how that goes. But there's this important nuance between it because not all shells are made the same. And so you have basically like three levels, if you will. You have fully reporting shell companies. Now, these are the companies that have gone through the registration process with the SEC. They have an ongoing quarterly filing and audit requirement with the SEC. It can be quite expensive. It can be a real pain. Administratively, it's a nightmare. And when you merge, right, the company that is taking control, right, also has to be audited. So it's not just as simple as like purchasing the controlling interest and backing in the shell. You have to also be audited. Then you have to do the requisite filing and you have to combine the financial statements for the previous 2 years. So there's a lot that goes into it. And those shells that are fully reporting tend to be far more expensive, more likely than not, because it takes a lot of money to just get them going. So whoever's selling them or at least has their money into them wants their money back. So that's the fully reporting route. Then you have just the regular non-reporting pink sheet tier, which is companies that do not have an SEC reporting obligation, have a ticker, are trading on OTC markets, and they have this sort of annual subscription and they report unaudited financials and very limited basic information through OTC markets. And that is kind of the sweet spot for an easy access reverse merger because you can simply buy the company. You don't need the audit. You don't need any specific filing with the SEC. You go ahead and you're public once you reverse merge. Now, changing the name, all that stuff, I'll get to it in a minute. Then you have like the gray market, they call it the expert market. It's been in a lot of different things, but those are basically defunct companies that have lingered as this sort of listless ship and either failed to report, are fully reporting and failed to report with the SEC for an extended period of time and have not also reported with pink sheets, OTC markets directly, and they've lost their ticker. They have a ticker, but it's traded by appointment, and there's a lot of work that needs to go into it to get it back up. They're very cost effective, but it requires an audit and a Form 10 filing to get what's called a 15C to 11 to bring them back up to the tier. So while they may be the least expensive, there's a reason why they're the least expensive, right? Because eventually you're going to spend more money than you would just buying a regular pink sheets to get one. So here's the thing. It works, right? It works. You can do that. You typically, as a non-reporting company like a pink sheet or expert market, you're not going to find a lot of institutional, if any, investors because of the lack of an audit. You can always, uplist to becoming a reporting company through the filing of a registration statement, but then you have to go through the audit process, and a lot of blockchain companies just can't do that. Like an audit is actually a difficult thing to accomplish in some regards because you actually have to have your house in order. right? You have to have had your house in order for like 2 years if that's how long you've been in existence. So it isn't this immediate assumption to capital, right? And the institutions are, especially any significant ones, and there are some niche ones, aren't going to be like throwing a ton of money at you. So it's not always the most useful gambit, right? Now, at the same time, yes, like if you have high net worth or different individuals and they want liquidity and you're not going to be able to give them liquidity via a token, right? Whether it be utility token or security token, yes, it will help because at the end of the day, you're selling them something that could, in fact, be sold on an open market and they could recoup whatever gain that they perceive to have obtained. So that's sort of the singular advantage. Now, the one thing that everybody overlooks is FINRA. FINRA is the gateway and sort of the guardian of the markets themselves, right? So if you want to do a name change, if you want to do like a reverse split, like and correct the capitalization of the company, which across the board, most pink sheet and lower companies have to have that because they'll have a billion shares and it's very messy. You have to go through FINRA to do that. And that can be very, very difficult. It's becoming very, very difficult these days because FINRA's looking back longer and they're saying, well, maybe this company's been turned over as a shell company 10 times in 15 years, and like we want all the records, books and records going back 12. Well, you're not going to get that with most shells because nobody has them, right? Because the way these companies become shells is one day everybody says, well, you know what, I ran out of money, I don't care, whatever the case may be, or they looted the company and they just walk away, right? So they literally are listless ships. And so to like rehabilitate them and then get them through FINRA is your biggest challenge. Finding the shell, easy. Paying for the shell, if you have the money, not hard. The actual merger itself, just basic corporate merger, okay, basic state corporate law. Getting through FINRA to like change the name. So instead of, Edwards HVAC Inc., it's, ABC blockchain. That's a challenge. And that's a whole nother video unto itself. But just to sort of understand the lay of the land in reverse merges and how they work with blockchain fintech based companies is just that. You've got these tiers. You have to understand what you're getting in. You have to understand what you're buying. And the due diligence is paramount because in the absence of due diligence in terms of what documents do you have, what corporate records do you have, how much assistance are you getting from former management and the like, and you tend to get more obviously with the reporting company because if they're reporting somebody's there, but in the absence thereof it can make life very, very difficult and you wind up not getting the benefit of your bargain because one, you can't truly turn the company into this branding machine where you can sell shares and you're also kind of stuck with it because who's going to want it if you have already failed with a name change and things like that. So I'll dive deeper into this, right? Because there's nuances to a lot of it and all that, but you see more and more, especially from Asia, like fintechs and blockchain companies jumping into this and like paying huge premiums for these shell companies. And I look at it and think, well, this is the China hustle all over again, but maybe they just don't know. And by virtue of what people see in the market, smaller companies or US companies that aren't necessarily aware are following suit and paying those premiums because they think that is what the market bears. And they're, finding themselves in these sort of pitfalls. So that is like really high level reverse merger stuff. I can drill down, we'll drill down at a later date. But have any questions, hit me up. You know where to find me. Adam Tracy. Talk to you next time. Cheers.